Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come onto that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes.
The system is running out of time. Trillions in debt must be refinanced, and the only way forward is lower rates and more printing. Markets know it, politicians know it, and now even insiders are warning that the clock is ticking. For crypto, this next year could be the most explosive yet, because what happens in these 12 months will ripple across every asset on Earth. That's the latest message from Rawl Pal, CEO of Real Vision. Pal is certain that the business cycle now stretches into late 2026, but the path between here and there is paved with danger. With $9 trillion in debt rolling over in the next 12 months, central banks are being cornered into the same response they've always used: flood the system with liquidity. Pal calls this the everything code, a framework showing how demographics, debt, and productivity force policymakers into endless debasement. And while traditional assets may lag, crypto stands to benefit the most, as scarce digital assets thrive in environments where money itself is being systematically devalued. Make sure to stick around until the end of the video, as Rawl Pal shows why missing this cycle could be the most expensive mistake of your lifetime. Before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, here's Rawl Pal with his market outlook.
The key thing, I've been an investor for a long time, as has Julian, and we've run diversified portfolios. That's what we've been taught to run. We now believe that diversification is dead, and the best thing is hyper concentration, which goes against what many, many people will tell you, but will explain why. And it all comes down to the biggest macro variable of all time, the most important. And I'll explain why this has happened. But what the issue is here is the global governments and central banks are increasing liquidity to manage debt at 8% a year. 8% a year is actually the devaluation of fiat currency that you don't see. It's kind of hidden, and we'll come into how it's hidden later. But this 8% is your hurdle rate to unfucking your future, plus you need to add inflation. Yes, it's in addition to this, because inflation is not the same as debasement. So you've got an 11% hurdle rate on any investment that you have. And once you understand this, it changes what you do with your money. Because don't forget, an asset that you buy is future deferred consumption. Some point in the future, you want to release that. And because you've locked money up for an extended period of time, you expect to be rewarded above what is happening to debasement or inflation. That is the whole point of investing. Now, what is happening is most things aren't doing that. We'll come into that. So anyway, just remember this: 11%. If your investments are not hitting 11%, you are getting poorer. Okay, the everything code. It all starts with this, the magic formula. The magic formula is how you think of trend rate of GDP. It's actually driven by population growth, productivity growth, and debt growth. Those are the three key factors that drive GDP over time, and it's consistent everywhere in the world. So let's start looking at these. Trend rate of GDP has been falling over time since the 1950s and is now around 2%. Okay, so why is that? Well, the working age population has also been falling. So the working age population means that it drives less economic activity. So the trend rate of growth there has been falling too. Also, productivity has been falling over time, which is extraordinary considering the technology revolution that we've had. It has not driven productivity as much as it could have done. Yes, the measurements aren't great. but also it's a factor because of an aging population, and we'll show that shortly. Debt growth. Well, debt growth appears to have peaked back in, let's say, 2009. We had the pandemic spike, but really it has been trending higher over time, and the structure of debt has changed over time. You see, private debt, the private sector's been deleveraging. It's now down to about 100% of GDP. Total debt is still about 340% of GDP. When we get to private debts, it's about 120% of GDP and has been falling, which is good. But total debt has offset it, the public debt. The government has actually taken on the debts as the private sector's delevered, because it's trying not to let the deleveraging slow down GDP any further. It has increased debt. Okay, so that's how the three dynamics play out. But let's look at the most important one of all, demographics. Demographics is the basis. When I first started GMI, the first article I ever wrote was Debt, Demographics, and Deflation. And that has been my framework ever since. So let's understand demographics. The US birth rate per 1,000 people has been collapsing over time. It is more pronounced in other nations. It's definitely more pronounced in Europe, China, Japan. So the Western world has basically the same issue, which is the growth of population, which drives GDP, has been falling. And that means that we can forecast into the future because we know when people become labor force participation rate, or they become part of the labor force. Now, for some reason, it's a 16-year lead. Maybe you could shovel it and make it 18-year lead. But really what we find is that demographics are destiny. They forecast where the labor force participation rate is. The labor force participation rate is the key thing for economic activity. So what we've got ahead of us is a trend rate of labor force participation rate declining. And what this chart shows, this is like the most important chart of all of macro, and I've never seen it produced anywhere else ever, because I don't think people understand it. This is the chart of the labor force participation rate versus government percent of GDP inverted. So what it shows is trend rate of GDP is basically offsetting the labor force participation rate fall as the population ages out. That is why we have a debt problem. That is why government spending is so hard to manage. It's because we have this aging population. That is the key to everything, and it's only going to get worse because of this. So this suggests out into the future, debt keeps going up. Now, the economic singularity will change this at some point, but we've still got this collapse in the labor force participation rate to deal with into 2030. And that's going to drive massive increases in debt to GDP. You see, these are in perfect mega trends. The labor force participation rate is in a beautiful log regression channel, and we should just move towards the bottom of the channel and beyond in the coming years. And the reverse of that is the government debt percentage of GDP. You can see them pretty clearly, the trend. Now, the next thing that we found that nobody else has found is that Fed net liquidity, which is the use of the TGA, the balance sheet, and the reverse repo, has been the main mechanism for financing the debt. So they're joint at the hip. And so what they're doing is using liquidity to finance debt. If we do this on a globalized level, it's actually global total liquidity that is the real answer to all of this. But that you show how close that correlation is. Yes, the axes are different log scales, etc. But honestly, don't mid-curve it. This is the key thing. They're using the balance sheet plus any monetary tools possible, including the banking system, to pay for the interest on the debt. So you can see total global liquidity. They've started using the banking system as part of this. So that's why we've started switching our key measure to total liquidity, not Fed net liquidity, because it includes M2 and other measures. And you see what's happening there is it is starting to rise, as is the debt to GDP again. Now, what's interesting is when we look at the interest payments, you can see that it's the liquidity that pays the interest payments. The interest payments, because interest rates are above trend rate of GDP, that needs to get monetized because there's not enough economic activity. If the trend rate of the economy is, let's say, 2% and rates are at, let's say, 4%, well, that's double the amount of economic growth to pay the interest. We don't have it. The government's 100%, 120% in debt, and the private sector is the same. So there's just not enough economic activity to pay the interest on the debts. So this is why they debase currency. It's the story as old as the hills, but it is incredibly important to understand. Try not to mid-curve this and overanalyze this, because this is what is going on.
Rawl Pal says the old rules of investing are dead. Diversification doesn't work when every asset is tied to central bank money printing. With fiat quietly debased at 8% a year and inflation on top, investors now need 11% just to stand still. That's why Pal calls for hyper-concentration into assets that can outrun the system. His Everything Code explains it. Demographics are shrinking, productivity is stalling, and governments are leaning entirely on debt. That debt is funded by liquidity creation, which links markets directly to central bank balance sheets, trapping the system in endless money printing. Now, back to Rawl Pal's discussion.
As I said, it's not the first time it's happened. It's actually happened in the 1950s, and it's happened in the past too. But to understand it all, you'll understand that since 2008, everything became ultra cyclical. Before then, we had a business cycle that shifted a lot. It wasn't as clear. There was much more diversification in investments. But since 2008, everyone's like, oh my God, everything is a bubble all the time. And it's all driven by this one thing: the servicing of the debt. You see, back in 2009, well, 8-9, every major government around the world gave themselves a debt jubilee. They paid zero interest on any debt, and most of the private sector got to zero interest as well. That allowed everybody to restructure debts. The private sector has been paying it off. The government has been increasing to offset that. But what they've done is they've created a 4-year cycle, or they had created a 4-year cycle. We'll come on to the shift in that cycle based on the debt refinancing cycle. So it's about a 3 to 5 year sector is where they've been operating at. And every 4 years, they've been basically refinancing that debt by printing money. And that happens over a 3-year period. And then there's usually a period where they withdraw money from the system before they start again. But each time it keeps going up. And that creates these weird cycles. So Bitcoin, some people thought it was the halving cycle. It's not. It's the debt refi cycle, because it happens in all assets, the NASDAQ, commodities, everything. And it's driven by this like spring, summer, fall, winter. And they're all corresponding to how much money they're printing at any one period of time. Winter's when they're not printing money, but the others are when they are. And so those are these economic seasons that we talk about. So recently we noticed that, hey, the ISM, and you've heard Julian and I not struggling, but trying to understand, okay, what's changed in our framework? Our job is to understand and double test our framework at all points. So when something major is changing, which was the ISM not fitting the 4-year perfect sine wave, we started thinking, what's going on here? The ISM is more subdued than it has been ever. And we found out that the debt had been moved in 2021-22 because interest rates went basically back to zero. They managed to extend the curve by issuing further out, and they extended the debt maturity from 4 and a bit years to 5.4 years, creating a new longer cycle. Now, we don't know what length the next cycle is. It depends on where they refinance this entire cycle at. But right now, we know we've probably got an ISM and a business cycle that extends well into late 2026, and that will affect asset prices. So this is why markets have been acting, well, crypto markets have been more subdued than people expect. And we'll come on to that in a second as well. The other thing is interest rates. Interest rates haven't needed to yet come lower, but now we're seeing the urgency from Scott Bessent, who understands the everything code, and Steve Mirren and Trump all saying we need to get rates lower. Why? Because we've got $9 trillion of debt to roll over the next 12 months. It's this 12 months that is the key to everything. It's this 12 months where maximum money printing comes. The way I try and put this is it is the single most dominant macro variable we've ever had. Correct. This is what the everything code is about. It is so dominant that only 3% of the NASDAQ variability is based on other factors. Now, the NASDAQ and crypto are both in secular uptrends built by network adoption models, but 8% of that is entirely just the debasement. The rest, the excess returns on that, is the network adoption model. But this factor is so dominant and so important that it's all that really matters. And that's why Julian and I keep saying everything else is noise.
Yep. So we'll keep going. And here's just another way of kind of visualizing that data, right? Here's our GMI total liquidity index again versus Bitcoin. You can see when it breaks out and moves higher, this is typically a good situation for risk assets, Bitcoin included. Obviously, the exception was COVID back in 2020, which I highlighted very clearly. But the point is this index is still rising. And then when we talk about global M2, and Raoul had discussed this on Drinks yesterday, yes, there's been a gap that's opened up, and that's pretty evident here. But I think, again, he covered this yesterday, but so I won't touch on it too long. But essentially, this divergence started opening up in July of this year, right? So that's when the divergence started building. But what we also know, if we look at the 16th of July, that was also when the Treasury General account started to rise. And the Treasury General account is essentially the Treasury's checking account at the Fed. So all federal receipts, be it taxes and payments like Social Security and defense, they all go through this, okay?
So when they increase the Treasury General account back up to the $800 billion level, what they're actually doing is taking liquidity from the system because it's now stuck in their account and not going around the system. So this increase, it's always the rate of change that matters. This rate of change matters because it was $500 billion. 2023, we saw a large rise in the Treasury General account. And guess what? Crypto markets were sideways to soggy as they are today when this happens. But we're very near the peak, and Julian will come on to that in a sec. But it's a very crucial thing what happened because it was a big withdrawal of liquidity that happened fast. And crypto is the furthest out on the risk curve. So it's the marginal effect hits crypto more than anything else.
Yeah. And the TGA is recorded as a liability on the Fed's balance sheet. So as Raoul says, when it rises, it drains. When it falls, it's actually adding liquidity. And the way, I think part of the way to explain this divergence is if we just take into account that Bitcoin's market cap is around 2.2 trillion. This is a $500 billion drain. And we just assume, just for a second, hypothetically, that all 500 billion of this would flow into Bitcoin. Okay, that means that Bitcoin prices would be around 23% higher, right? If this TGA rebuild never happened. And so that would put Bitcoin, if we're looking at prices today, we're at around 111,000, 140,000. Now, again, it's unreasonable to assume all this liquidity would go there, but I'm just saying, I think if we take this into account, this explains partially.
It also explains why the year-on-year rate of change of global total liquidity,
yes, has ticked down a little bit.
It's ticked down because it's the US rebuilding its general account. Now, again, we're not expecting M2 to be perfect. What we're saying is explaining is why it's diverging now. And it's not some other weird factors. It's the furthest out the liquidity curve and a bunch of liquidity has been withdrawn. And this is all to do with the debasement idea and how debasement flows through the system. So it's pretty consistent.
The system is running out of road. When interest rates are set above the economy's growth rate, there isn't enough activity to service the mountain of debt organically. That forces governments into one outcome, monetization. They print money to pay the interest. Since 2008, this has created what Rawl Pal calls ultra-cyclical liquidity waves, dictating 4-year seasons across every major asset class. Stocks, commodities, and Bitcoin have all risen and fallen with this tide. But the last refinancing cycle in 2021 to 2022 stretched maturities, pushing the peak into late 2026. That bought time, but it also magnified the pressure. Over the next 12 months, $9 trillion in debt comes due, making aggressive money printing unavoidable. History shows that when liquidity floods the system, scarce assets absorb the capital. And in this cycle, crypto stands as the ultimate beneficiary, not just for a trade, but as a survival strategy in a world where fiat erodes year after year. The question now is, who will be positioned before the wave hits? Are you prepared for the largest transfer of wealth in modern history, or will you be caught holding assets that melt against the tide of liquidity? If you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Don't pass up the chance to stay updated and make informed choices in the crypto market. Anyway, guys, I hope you all enjoyed today's video and that it gave you some value. I'll see you all in the next one, and as always, all the best.